Does anyone know this is a Kraal? This is a Kraal. Yes. It's by. Absolutely. I'm Brenda Matumise, MD of Communal Investments, a company that is involved in hospitality. I'll be facilitating this session this afternoon. With us, the panelists, let me start with the gentleman that I know and I worked with for a good 6 years in the Hospitality Fund. He still looks young. That's Kamil Abdul Karim. As you know, Karim is with Holding Tourism and Hospitality Consulting, a consulting division providing strategic consulting services to the hotel industry. I think some of you have used his services, and if you haven't, you can start from today. And he focuses both in sub-Saharan Africa and mostly here at home. Camille, by training, is an accountant at UNISA, and we hope that that's correct, that is true, we will verify. And he spent his earlier career in accounting and finance, and developing into a CFO for 2 global companies in the service environment. He embarked on a postgraduate studies, completing a PDM Public Policy Development Administration at Vet Invest in 1996, and went to achieve his MBA with Bond Invest in Australia during 1998. He has served as a strategic marketing at Southern Sun Hotels, and currently, Camille, as I said earlier, is a managing director of Pem Golding Tourism and Hospitality Consulting, as well as a non-executive director of Hospitality Fund, as listed on the JSE, and he's also a board member at the School of Tourism and Hospitality at the University of Johannesburg. So, welcome, Camille. Warm welcome to Camille. Then we have Christine Engelbrecht. She's with the IDC. She has turned down most of us down when we're looking for finance, and hopefully today we will be lucky enough for her to push a different direction. Christine is a qualified CA and have completed her articles with a firm and was a audit manager with Coopers Labyrinth, which is now PricewaterhouseCoopers. She joined IDC in 1999. Over the past 15 years, she has gained experience in various business units within IDC, including agro-industries, tourism, workout and restructuring, and corporate and structured finance. She was appointed as the head of the Franchising Strategic Business Unit in October 2007 and was transferred as the head of the Tourism Strategic Business Unit from April 2012. So she's going to tell us from 2012 till today how many deals she has approved and how. A warm welcome to Christine, ladies and gentlemen. The next gentleman, I met him earlier on, Stuart Smith. Yes. Oh, it's wrong. Okay. We'll correct it. And I'm going to correct it via you. Right. So let's correct it. You've got a mic there.
Stuart Smith, Hospitality Development Group Advisory, or HDG Advisory. We provide core consultancies with core discipline in executive search and human capital management.
Thank you, Stuart. Warm welcome to Stuart Smith. All right, last is Dominic Ho. Dominic is not from here. He grew up in Brighton, England, educated in England, and holds a HCIM. In short, it's a hospitality qualification, tourism and qualification. In 1989, Dominic joined Hilton International and worked in Germany, Frankfurt, Munich, and Berlin. Abu Dhabi, now South Africa, Johannesburg, and Durban. In 1990, Dominic resigned from Hilton International and joined KPMG in South Africa as part of their hospitality division and lodger and tourism advisory unit. His main motivation being that he recognized that tourism opportunities not only in South Africa, in particular in Africa in general, are important. So he needed to branch out on his own. He headed up the business unit from 2001, sorry. He resigned from KPMG in 2008. In 2010, Dominic started to work with CI Holding Limited to head up their hotel acquisition and development team. Between 2008 and 2010, he enjoyed a brief respite from the hotel industry and pursued his hobbies, many military history and charity work. Dominic is married with 2 children and he lives in Johannesburg. Now, ladies and gentlemen, a warm welcome to Dominic. We are in safe hands because the 4 panelists know the subject matter under discussion for today. The debate that must happen this afternoon is about what are the challenges that we all experience in relation to investment in the hotel industry. As we're all looking for loan finance from banks, from DFIs, what remains a problem? If what is available is not working for hotel industry, what other financial instruments can we come up with? And how can we approach other funders if they're not banks? And how are these gentlemen and the lady, especially IDC, how do you typically evaluate these projects and decide that I'm going to fund? And how do we need to present our proposals to bankers, to DFIs, in order to secure the funding that we're looking for? So I'm going to start with you, Camille, and answer the questions that I've put across. As a consultant, as a holding consultant, having worked with different individuals and groups in assisting them to acquire a hotel property, what is your advice and how do you help them to package their proposal to be funded by a bank or a DFI? Does it have to be different for the bank and for the DFI? Let's start there.
Okay, can you hear me? I don't need that.
No, we can't hear at the back.
Thanks. Can you hear me now, you? I just attended the session earlier on in terms of the technical side of putting up a hotel, what needs to be done. And I think especially the lady from DHK was very clear as to the importance of the preparatory work that needs to be done before you embark on a hotel development. And I think the resounding opinion that came out of the panelists there was the importance of a feasibility study. That's the business that we're involved in, and trust me, I'm not punting this because we do feasibility studies. But a very important part of being able to unlock capital is being able to present a substantiated, sustainable financial model in feasibility study. Can the market absorb a new hotel? So often we find, especially from an investment Kraal perspective, and I'm not just looking at it commercially, I'm looking at it more from a DFI and public sector funding perspective, is, I've had situations where clients call me and say, oh, the IDC is giving this amount of money and the NEF has an advert that says, I think it's 1 million or 2.5 million to 75 million for women investment. And, we can just walk in there and get this. People don't do their homework as to what they want to build. I've got a project somewhere in a rural part of South Africa that I have to do a proposal for. It's for a massive mixed-use development amusement center. And, the thing is that what thought has been put behind this, but yet they are getting the money to actually do this exploratory work up front. I'm happy with that. But at the end of the day, what's the legs for it? And the importance of the feasibility study then is critical to not just telling you whether the project's going to work, but to also unlock finances, whether that be through commercial banks and whether that be through the IDC or NEF. And to give you an example, I mean, Christine, we've worked on a few projects together, and there's a few projects that we've worked on that Christine or the IDC is funding. So I think Christine will also reiterate what I'm saying. But the important part is be structured, be focused, understand what you're going into. This hospitality industry is not the romantic kind of business that people seem to, especially emerging entrepreneurs, seem to think it is. It is one of the hardest businesses to survive in, so do your planning properly.
Thank you, Kali. Stuart, same question. In your experience and the role that you've played in advising your client, what do you say to them in how they should package their proposal for funding?
Well, I'd have to concur with Camille and say that one of the most important things is having a well-done, well-thought-out feasibility study. And that's on the road to getting your ducks in a line. But no bank is going to finance you if you don't have a team behind you, a professional team that can actually execute. That's usually meaning aligning yourself with a brand. That doesn't mean you have to build a brand hotel if you have intent of developing a standalone. But if you don't have a brand behind you, you're going to need to have professionals that have a work history, that have a profile, like what was read off about my colleague next to me, on the history of operating in the hotel industry, and having a support team that can manage all the disciplines of the property. So certainly having a feasibility study is on the road to getting your ducks in line. And then, of course, identifying where you're going to find capital, having equity, having your own capital to go into the deal. No one's financing any hotels with developers, certainly new developers that don't have at least 50% equity in the game. So that presents its challenges, or that kind of eliminates a number of developers or investors from the jump street. But what you will find is that most high net worth individuals globally have hospitality in their portfolio. So therein lies why many people think it's glamorous, but it's about real estate. This is truly about a real estate game. So that really removes the glamour, as Camille's talking about. I mean, if you can find a sex appeal in real estate, dirt and rocks, and of course, then there it is. But it's really about preparing yourself for success, a plan that's executable, with proven pro-forma numbers, and then having a team together that can actually support what your future success is all about.
Thanks, Stuart. To Christine, we know that the IDC has been playing some role in the tourism and hospitality sector. Is there still a focus and a push from IDC to continue to look into this sector? And can you also touch on where your funding is focused, whether it's focused on secondary cities and rural development? And as you respond, also touch on the typical transaction value cap and the gearing structures that should be in place.
Yes, tourism is definitely still a key focus area for us. At the moment in South Africa, we focus proactively more on business hotels in secondary cities which may be linked to other economic development and infrastructure development happening in those cities, as well as attractions. Not saying that we won't look at applications as they come through the door in the normal course, but from a proactive deal sourcing perspective, that's our focus. And then our focus at the moment is very much on the rest of the continent. And I think we've heard enough over the past few days about the potential and the potential that there is in the rest of the continent. With regards to our funding requirements, obviously economic viability is the underpins any funding application. We normally work on a 50-50 debt equity structure with our focus mainly on the debt finance. we could provide a portion of equity funding where it is for BEE candidates who don't have the full own contribution that's required, or for special groups, for instance, local communities or workers. A variety of, we have schemes available from the women group in youth who wants to invest. So the security is normally based on the property that we invest in, or the land and buildings, as well as personal sureties, and obviously requirement to adhere to all the laws of the country, but specifically also international environmental standards.
One of the criticisms leveled against the DFIs is your turnaround. Someone has done everything. They've done the feasibility, they present it to the IDC, but your turnaround is quite long. How do we overcome that? And bearing in mind that these are entrepreneurs, they want decisions to be taken sooner so that then they can get on with the business.
I think our turnaround times is very much dependent on the level of detail and the completeness of the information that we receive. Once we have, how the process works is that when we get your business plan, we will quickly look through it, make sure all the information is there, ask for additional information. Once we have all the information, we do what we call a basic assessment, which is essentially a desktop assessment of what's in the business plan, based on which we make an in-principle decision of whether we're prepared to go to the next stage, which is the detailed due diligence. And at that point in time, we need quite a lot of detail. I mean, on the technical side, as we call it, want the level of detail of detailed bullet quantities, detailed plans. It's not high level, and I think that's often where the confusion lies, is that we get a high level business plan, but the details is not drilled down into. Because obviously by the time we need to make an investment decision, we need to know almost to the last cent how much it's going to cost. So once we schedule a due diligence, we have two processes. The one is for a non-complex transaction, which is a simple, straightforward loan finance only. The project is investment ready, everything is in place, there's no complications. There we have a 3-week turnaround time from commencement of due diligence to approval of funding. For complex transactions, and very often, especially, well, the transactions in the reference time continent will definitely be complex transactions because there are a number of complications just with regard to the legal framework of operating in different countries and so forth. There we would normally take about, I would say, 8 to 12 weeks from commencement of due diligence to approval.
Thank you. Dominic, tell us what is critical in presenting a greenfield opportunity?
I don't suppose many of you know or have heard of CII. We own 2 properties. One is the Hilton in Cape Town, and the second is the Conrad Kazula in Knysna. So both of those properties are ours. My remit within the group is the development and acquisition of properties. Greenfields is always interesting because, especially when it comes to funding, banks don't like hotels full stop, and banks really don't like greenfield hotels when there's development risk as well. So it is very difficult from a funding perspective. Greenfield sites, again, it depends on where it is. If it's a greenfield site or a brownfield site, we're going to demolish a building and build again. The processes are the same for any development in property. Hotels are a lot more complex, as Camilla's mentioned, purely and simply because of the detail that has to go into driving the revenue streams and through that the profit. We generally know the first couple of years are going to be difficult, and whoever your shareholders are, or your equity backers in particular, need to be able to fund any operating losses for the first couple of years. The banks are important in that because, and I think this is where there's a big disconnect in South Africa between the hotel owners and developers and the banks. The banks don't seem to understand hotels for what they are, and it's a very, I think, I wouldn't say South Africa specific, but it's quite South Africa specific in how they treat and look at banks. There are no specialists that I've come across on their credit sides when it goes up to credit. They've been burnt too often. A hotel is like any other business. Either you've got a good business plan or you haven't, but the story has been sold perhaps incorrectly or misunderstood by banks, and they've got too many bad plans rather than good plans. But you can have that in any business. I think the difference is here we talk hundreds of millions, whereas if you're opening a small corner shop or a franchise, you may only be talking $1 million. So if a bank loses $1 million, it's still not good. If they have to write off, tens of millions, there's a big difference. Again, with development, you need to have strong backers. The equity's got to be right. Brownfield sites in particular, and greenfield sites in some of the secondary and tertiary areas of South Africa. If the right incentives are there, it helps with the debt. You get your tax grade, your tax incentives. So having interest that you can write off isn't sometimes as important. So there's a lot of things. It's not something you can really answer in 10 minutes. You've got to look at them individually. But the important things are: is it solid, and does the bank understand what you are trying to do within that development or that hotel that you want to build?
Thanks, Dominic. Please feel free to raise your hand if you want to ask a question, because this is going to be interactive. So, Joe at the back, is there a question?
Yeah, I think what probably needs to be added to what Dominic just shared is that we then dealing with a whole new approach of many of the operators that are also only now invariably considering a management contract only, and that poses a problem to the bank. It's not bankable, so that's an additional challenge in terms of financing the new project.
I agree. I think the operators, big international operators, are slowly coming to the party in different ways, but they won't give guarantees, and most of them can't because of the way they're structured, primarily in the USA. They're listed companies and they have other responsibilities to their shareholders. I think I'm hoping there's going to be a fundamental shift in South Africa over the next 10 to 15 years, in as much as we now have the REIT legislation, which is the Real Estate Investment Trust legislation. There's a lot of benefits to certain types of investors. If you look at internationally, also internationally, particularly America, we have to look at America when it comes to hotels because of the 100,000 kind of registered hotels, 50,000 of them in the USA and the other 50,000 around the world. So how they are structured and how they're put together in the States is probably very, very different to many other countries. But what the REITs allow you to do is they allow properties that have already been built, where there is an income stream to put back into dividends. They can then go and buy and invest them. The first one we have here is HBF, of course, Hospitality Property Fund. So we need more of those. The banks, again, I think the banks, taking aside maybe IDC and the DBSA, but the big mainstream banks, they're not really interested in one or two properties. It doesn't help them. If you go to them and you want a big transaction for 15, 20, 30 hotels, there's a lot more different leverages that they can use. They've got a big basket of opportunities that they can help you with when you're big enough. But if you're small, then you really start struggling. I mean, we have the same. We have 2 hotels, and we're looking at raising some finance. Well, I can tell you now, if we blacked out what the hotel was, that it was a hotel, what the business was, and we just gave the numbers through to credit, every bank in South Africa would fund it. As soon as they see the word hotel, it's a red rag to a bull. So it does make it very, very difficult when you're going forward, when you're small. And, we only have our 2 little hotels at the moment. So what you're saying, the operators are very important because they can, from a banking perspective, they do give some cover and some comfort, I think, that the international can work. We saw it in our hotel in Cape Town. I mean, what Hilton managed to do there has been incredible in terms of the turnaround and the push that that big engine has given the occupancy and the bed nights. You could put it down as a test case because it's, the numbers that they're churning out now compared to 2 years ago has been unbelievable. So there is a good reason to have them. I'm not saying the South African, the domestic operators are any different, but I think it brings a different aspect and angle to it. But the operator is important. Will they underwrite and guarantee? I'm not sure. Maybe in Joburg, perhaps in Cape Town, but not in most of the cities.
Christine, does the word hotel scare you as IDC? And to all the panelists, why is that the case? That bankers, when they see hotel, they freeze? Let's start with you, Christine.
No, the word hotel doesn't scare us. We have a dedicated tourism strategic business unit in which we believe we've built up some experience and expertise in the hotel industry and how it works. And I mean, to your question about the turnaround times, I think Camille will tell you that we do a thorough due diligence. I think what, to a large extent, not to offend my colleague from FNB, we don't fund just based on security. We fund based on a business model. So we want to understand what's the drivers of your business, the supply and demand dynamics, all of that, and that does take a bit more time. I think the difficulty with hotel projects is it's project finance, and you have all the risk associated with project finance, but you don't have a guaranteed offtake, as you would often have with infrastructure projects or with mining projects or where it's commodity based. You're exposed to market risk. So hotels are more vulnerable to market fluctuations than your typical project finance type businesses would be. And I think, I mean, we've learned, I think, this, especially in the recession period and post-2010 period, with some of our investments, not with all. But I think even in that, our approach is that we need to assist as far as we can those businesses to get through the difficult period, because we know the hotel industry is cyclical, rather than just run to attach assets and liquidate as a first port of call. So we would also go through a period of assisting hotel operators and or hotel owners to get through the ups and downs as a first port of call.
Stuart, your comment on that?
My comment would be that it would appear that South Africa is still living through the post-World Cup cycle, and banks are just now depleting the non-performing assets. And as such, that's where the sting still exists on why they're not hot for hotels. I mean, clearly, if you look around South Africa, banks were bullish on building hotels. There's no question. Even leading up to 2010, when they became subject to some hoodwinking by the World Cup, which is the first time that's happened. But that's really the basis. And unfortunately, that is driving the philosophy of the banks, which really don't have a depth of experience to really understand the hospitality industry. I'm not taking a shot at any bankers that might be here, but it's safe to say that most of them don't have a real depth in the understanding of the hospitality industry, whether it's regionally or globally. But if you look at how hotels perform on a global nature, I mean, there's something that can be gleaned on how that is impact or how that will happen within South Africa. And I hear a lot at this conference that hotels are cyclical. And, well, economies are cyclical. I don't think hotels are any different than economies. You have to manage through those periods. So if economies are cyclical, then every business is cyclical. So hotels perform as well as as you prepare yourself to perform. Good management, with good investment models, with a good strategy, great debt structure, debt to equity structure, just really good professional management. That's it. Good advice. So that's what I think that the philosophy will turn, will change throughout this decade as that history of all these assets kind of go back into or sold off. But I think that's what's really stagnating, certainly this region.
Camille, you touched on a feasibility study, and I think everyone seated in this room and outside know that it comes with a cost. Is there grant funding for a feasibility study?
Yeah, there's not too much grant funding available for feasibility studies. Sometimes when particular local municipalities promoting a project, they might put some money into it. The NEF, especially because of their responsibility in terms of community project development, they invariably would finance projects or the feasibility study on projects that they feel is something that they could take to the next phase. But I think with the IDC, typically you require that feasibility study or business plan to be presented to you. But if I may indulge and just make a comment on the previous point, I think I fully agree with what you're saying, Stuart and Dominic. There is a lack of absolute understanding and knowledge of the hospitality industry, what are our revenue drivers, especially from the banks. And I think often the term is used, who's the jockey on the project. So the bank tries to extract some sort of comfort from the operator. Now, whether that operator is on a lease basis or on a management contract basis, the banks seem to get some sort of level of comfort from that. But the flip side to it is banks always like the operator to actually have some skin on the table. But if we look at successful hotel businesses, and if I can just indulge, and my colleagues are here from Hospitality Property Fund, one of the reasons that Hospitality Property Fund is good at what it does is it has an exceptional asset management team. So this team is basically looking at the performance of their 23, 25 hotels or 6 billion rand worth of assets throughout the country. And I think this is becoming an important part in the success of the funding and operations of hotels, is that there needs to be an understanding that, look, management companies are actually not going to be putting money, they're asset light. The developer needs funding to get the hotel project off the road. So where does the bank, where does the financing agency actually look for some level of comfort? And I think there the independent asset management of hotels starts to become a critical issue. We worked on a project where the hotel, it was a land claim. The hotel belongs to the community. And the community were pushed from pillar to post. It was one management company, they went down, another management company came on board. And before we knew it, in a period of about 12 months, of about a year, this business lost over 8 million rand. Now my colleague Wayne is sitting here and he's quite an expert in this, in asset management. He actually comes from Hospitality Property Fund. And we were able, within 3 months, to actually arrest the trend and be able to turn this business around. And it just shows that if the right focus is put onto a business, the management company in this particular situation saw the funder, which was a parastatal agency, it's government, they'll just put more money into it. Nobody cared about actually managing the property. And at the end of the day, it's not the community that's the biggest loser, it's actually the funding agency that's the biggest loser. And I think from our direct experience in something like that, asset management is probably that bridge that's being created into the future between the debate on whether hotel management companies should have skin on the table, or whether the funding institution and the owner need to be able to manage the manager or the hotel management company closely.
Thanks, Camille. Any questions from the floor? Before I proceed with my questions, because I've got a lot. Yes, sir.
Just maybe a comment on that. I think part of the problem is that as a funder you are looking to see what commercial buy-in is into the project, because ultimately as the funder you shouldn't be the source of the entrepreneurial judgment as to whether this is a commercially viable venture or not. And if you don't have operators who are willing to actually invest in the project, then committing to a project to be the operator actually almost means very little. Because they might say, well, we know we can manage this as a Hilton or whatever, but have they actually spent the time to assess whether this project is commercially the best done in the right way? So it's a challenge, and having asset management capacities for managing the assets, before that you need to have the commercial judgment to whether this is an optimal project or not. And I think that's where the difficulty lies, really, is making that judgment.
Yeah, thanks. Dominic, in putting together the two hotels, the Hilton, can you just share with us the process that you underwent and how long it took you to develop, raise funding, and be able to have a stock like the Hilton that you have in both Durban and Cape Town and in Johannesburg that is there?
Okay, I can only talk about, although ironically I was involved in Stanton and Durban Hiltons when I was working for Hilton, and Cape Town when I was working on the owner's side. I'm a balanced person, I've got a chip on each shoulder now. But what is, the Hilton in Cape Town, it was a printing press, it's in the Burkup, I don't know if any of you know, it's on Baitengracht from Wales. The owners there, it's privately owned. There's two wealthy South African individuals who own the company, and they wanted to have the hotel. They're Muslims, and they're quite strict in their belief system. And the hotel started off its life as Kraal International, which some of you may or may not be aware of. For a number of reasons, that didn't work. Primarily, it's a brand that was unknown. I think the marketing agency could have done perhaps a slightly better job. But to cut a long story short, after about 12 months, we went to the operator who's Middle Eastern based and said, look, we need some support, some financial support. Can you kind of help us? Cut a long story short, he says, no, we can't, and by the way, we'd like out of the contract. So you're now sitting in a bit of an issue. So you've got an operator who's got a contract over a period of time, and you can hold him to it, but he's not going to put his back, back into it. And so we went through quite a long process of choosing operators, and we ended up with two operators. At the end, it was the Hilton Group and the HICA Group to take over the management and operations of the property in Cape Town. That process only lasted for us not even 3 months. It was very quick because when you sit there and you don't have to go to long and complex boards, you then have to go and see a credit committee and this committee and that committee. If you're there and you are the jockey, it's much easier to make those decisions in meetings. So it went very, very quickly. We still have the same values. The hotel is it's still a Sharia hotel in terms of a funding perspective from our side. So the owners are happy with that, and it works well. The overnight, as soon as Hilton turned the tap on in April 2011, the occupancy trebled, quadrupled within the month. You can't even compare it to beforehand. I don't know how many of you are hoteliers. We've had RevPAR growth in excess of 30% every year since Hilton have taken it over, and that's in an economy that isn't working well, basically. So, I can say hand on heart, they've done very well for us. I believe they could still do better, but then again, it's our money, so I'm always going to say that. But I think deep down, they've done a good job. It could be a better job. But overall, I found it's easy to work with international operators. They need to understand what you want to do, need to understand what they want out of the deal. And then it's working together. It's important to have an asset manager, and some of you may have been in the session this morning with Bill Perry. He's our latest import from the USA. There's a seasoned asset manager out of the USA, and he manages that property on a daily basis. from our perspective. And it doesn't matter who you are. We all sitting here, everybody here, we all make mistakes. Hotel operators also make mistakes. I don't think they wantonly do things wrong, but you need somebody to check the checker, as I always say. And that's what an asset manager does. And it's simple things is, why did you have 15,000 rebates today? Yeah, what happened last night, what went wrong? Because that's 15,000 and it's ours. It's not theirs, it's ours. They get a small fee of that. So the asset manager, if you want to play this game properly and really sweat that asset as best you can, the asset manager is very important. And he has to understand the business. And then you can start making things work. And that asset manager has to work with the operator. You know, the beauty about hotel operators is they own nothing. So my general manager, who does he report to? Does he report to Hilton? Maybe. His responsibility is to me. I own his contract. I pay him. So he must listen to what I want as well. He may have other reporting. Now, the hotel companies don't like that, obviously. But they don't own the staff, they don't own the cash, they don't own the property. And if it all goes pear-shaped, they take their screwdriver and take their name off the front and move on. So an asset manager is very, very important. But it's a relationship, and you have to work on that. And it's like anything. You know? Some days you have great days, the next days you have bad days. You know, you fight, argue, and make up. You know, it's no different to any other business. But that's how you actually spend these assets and make them work. And that's something I think where, especially, perhaps not the IDC and the DBSA are special banks, because they're not your normal hard-ass in your face, give me my money back. They're not like that. They do change after about 5 years, but they have other responsibilities as well. You know, it's job creation, investment in previously disadvantaged areas, etc. But at the end of the day, they are still a bank. But there's a bigger grace period and there's a much better understanding compared to perhaps some of your mainstream banks, which is you're just another investment as from their side. And it's one that they don't understand. Again, I go to the States, you go to Wells Fargo. Wells Fargo got 30 people in their hotel division. They do billions of dollars of turnover. You know, Morgan Stanley are the same, but they understand it. You know, we need to. I say we, the banks, if they want to play in this field, they need to start looking at that. And I think the mainstream banks, they have a duty to their shareholders to not say no to hotels, because they don't know what they could be potentially missing, and that's very important. I think.
Stuart, we spoke about the banks and the DFIs. In your experience, have you had to advise a client or even bring a private equity player into a transaction, hotel transaction? And what are they looking for, private equity?
Good question. I think everybody, when they look to financing a hotel, should start long before even the feasibility work is done on where the capital is going to come from. Particularly in this market, in sub-Saharan Africa, when you have to bring 50% to the table. You need to stack financing. You need to look to for private capital. You need to look to sovereign funds. You need to look for banks that support that. You need to do due diligence on banks that actually support investment in hospitality. You think because you have a great banking relationship, because you put all your money and your family puts all their money in F&B Bank or Net Bank, that they're gonna want to see you when you come to ask for that money back and a loan for your business. It's really not like that. You don't take a Ford pickup to a race with sports cars. So you got to do your research on that. There's a lot of private equity money out there that's coming into investing into the lodging sector. Much of that money doesn't know where to find the opportunities, and vice versa. So it requires some real due diligence, some real research. In my experience, I've seen deals structured where there's 2, 3, 4 lending sources. That's where the term mezzanine capital comes from. Sometimes that's stacked a couple high too. But there is a lot of money out there. There are private sources out there. I can speak from my part of the world where there's a lot of private equity that's looking at Africa, that's moving into Africa, investing in various segments within hospitality, not just in hotels, but in restaurants. and they're looking for deals. They're looking to spend that money. They have to turn the money over. So it's not as bad a picture as it is, but I think it's the most important step before you start thinking about, you know, what that design is going to be, how many rooms you're going to put together, you know, what colors are the drapes. You need to put your financing together first.
Okay, let's then move a bit south and east and West Africa. Christine, you indicated that IDC, you're also looking at into the continent. Are the requirements different for South Africa and the rest of the continent, West Africa in particular? And I would like all the panelists to comment on that. So let me start with Christine and then move over to Dominic, Stuart, and then Camille.
The requirements are essentially the same. What is important for us in the rest of Africa is that we will require political risk insurance and in some cases commercial risk insurance as well, depending on the country risk and the project risk, which can be obtained through the ECRC, and in some cases from time to time they also have schemes that's beneficial on interest rates. So, yeah. What is quite important for us as a development finance or a South African-based development finance institution is that there must be some benefit to South Africa, but there must also be benefit to the host country. So the benefit to South Africa is normally through the export of goods and services, the professional teams, often depending on which brand it is, a lot of the FFE and things like that come from South Africa. And then obviously for the host country, many countries require that there must be a local partner involved, as well as the job creation and local sourcing of the other obvious benefits to the host country. And in those cases, because of the distances during the construction period, we would require what we call a lender's technical advisor, which is basically an independent, normally a quantity surveyor or a civil engineer who will oversee or just monitor the progress on the project, on the construction, and report directly to us as the financier. So they would basically oversee what the project management team would be doing on the ground. Okay, Dominic?
I don't want to go really divulge into our strategy, etc., but we're looking very strongly into Africa for development. We are only interested in holding hotels as assets. We're not interested in managing them. We want the big international brands to look at that, the Hiltons, the Hyatts, the Starwoods, etc. Because that's their business. We want to be the asset manager. We want to own the asset. Looking at Africa, the one that really sticks out like a sore thumb is Nigeria, Lagos in particular, Port Harcourt, Abuja, just to name some of those areas. In terms of returns, they far outweigh anything you'll get in South Africa, or perhaps even most of Africa. So that has got to be an area that if you're interested in playing in the field, you have to have a good spread of hotels in those cities in Nigeria, purely because of the returns. Is there risk? There's no more, no less risk than you have in South Africa. It's generally dollar funding. I mean, with the IDC, they've got some really exciting packages. In fact, it's too good because when I use the IDC numbers in my models, I get IRRs after 7 years of 51% and things like this. So it encourages a lot of interest into those projects. There's difficulties in ownership of land there and who owns what and who does what. But Nigeria, if you understand it and you've got the right partners there, you can make a lot of money. If you've got the wrong partners, you'll see your backside. I was going to be rude there, but you're gonna be in trouble. So you have to do your homework well. There are lots of checks and balances there. They've got quite an active stock exchange. If you are worried, you can list the company, keep shareholdings. There's lots of things you can do there. We've looked at Ghana. We've looked at surrounding countries, Namibia, Botswana, Zimbabwe, etc., East Africa, Tanzania, Uganda, Kenya. So there's a lot of opportunity out there, and there's a lot of money to be made. There is different risk. As much as I don't enjoy that, there's no insurance people here, but as much as I don't like paying for insurance, the MEGA from the World Bank or the ECIC here, you need to have them just to do your equity providers a good service. They generally don't want it, but you do have to have them with them. But I think from a company registered in South Africa, you have to be in Africa because it stabilises your income because of the volatility of the rand as well.
Stuart?
First, I'd like to say that risk is a four-letter word. You hear the banks use it, but if risk was a problem, then why is everybody developing in Nigeria? Where Nigeria has Ebola, they have conflict in the north, 300 girls missing, nobody's looking for them, but everybody's investing in Nigeria. Why? 160 million people, fast-growing economy, rates that really don't fluctuate. I have an article that I kept, it's 3 years old, that rates were $500 a night in Nigeria 3 years ago. And as a group of operators, they decided that they were going to adjust rates. They adjusted them to $250 a night. So is there revenue management into that? Is there any science in that? No. But the reason why you can make so much money in Nigeria is because the average rates run about $300 a night, anywhere. So it's an underbuilt market. Much of West Africa is underbuilt, and that's why everyone's trying to fight to get into that market. When you talk about, I start by saying risk, all the banks are trying to put money in there. Even the operators, as quiet as it's kept, are putting a little money into getting these deals done because they want market share. The reason why Residor is ahead of the game in developing is because they put money in the deal. And we saw the panel today. All the operators, all the big boys were saying, well, we're happy with our development strategy of asset light. They're all singing from the same hymn book. The truth of the matter is that if they were happy, they would be putting 50, 60, 100 hotels a year down, like they do in other parts of the world. So how are they happy with putting 4, 3, 5 hotels down? So I know that's kind of a broad stretch, but they're fighting to get into West Africa where demand is high. South Africa is pretty much a saturated market. Other areas in Southern Africa like Mozambique and Angola, some barriers to entry, language is some of it. The way you do business is also. Nigeria, Senegal, Ghana, free market economies. You can put your money in, you can take your money out. And so that's why West Africa is developing at the rate it is. My opinion.
Okay. Camille?
Yeah, I just want to clarify one thing, is that the most expensive city to live in Africa is actually Rwanda. You pay $300 for a shitty 3-star room.
Not South Sudan.
It's like your 4-letter word. But having said that, the anomaly between everything, probably just, let's say, a bit further north of the SADC region, but let's include Tanzania, Angola, is that equity that is required is available. It's not like the South African market where, and just going back to talking about 2008, 2007, one of the reasons that banks went into problems is that every man and his dog wanted to build a hotel, and nobody put any equity in. Banks were funding 80, 90%. So ask me why the banks are in problem, I would redirect that, ask the bank why they lent, why they geared these projects so highly. In Africa, one of the problems is that most of the countries have a very high interest rate regime. So in Angola, whilst the developer would have his 50% equity, the ability to raise that money locally is there. The local banks would fund, but you're talking about interest rates of 11, 12% upwards, 10% upwards anyway. What we find is in the work that we're doing in Africa, we're busy with a project in Tanzania at the moment in Dar es Salaam, is that the equity is there, but the biggest advantage of being in Africa is that international DFI, Sweet Fund, Nordic funds, Danish development funds, definitely see Africa as an area that needs more attention than South Africa. And therefore they have access to those dollar-based funds at dollar-based interbank rates, rather than the kind of lending rates that we are seeing in South Africa. So, yeah, opportunities are there in Africa, and I think working with the right developers in Africa definitely leads to successful projects, but the development pipeline tells you that.
Okay, comments from the floor, quickly? Okay, your closing remarks. In your closing remarks, you should attempt to address anyone sitting here who has got an appetite to invest, or possibly has got an opportunity and they don't know where to start. So in your closing remarks, attempt to answer all the questions that an entrepreneur would want those questions to be answered. So Camille, let's start with you.
Yeah, I think Dominic's made this point abundantly clear through and through in everything that he said, is that if you want to be, bottom line is, if you want to be in this industry, understand this business, be able to manage the manager, be able to look after your own business interests, and where you don't have that skills, make sure you have the right associate, the right partner, homegrown tourism hospitality consultant, to drive you through the process. Thank you.
Christine?
Yeah, I think it's essentially the same message, that a feasibility study that is done by an external party is key, but it's important that you add to that to make it a business plan. It's a plan for your business. It's not a tool to raise finance, it's a plan for your business. And you have to monitor progress, you have to monitor the operator, you have to make sure that you stick to the plan during the construction period, during operations, so that you execute on the plan. Stuart?
I think I want to make clear one message, is that Sub-Saharan Africa is probably the best opportunity for developing hospitality assets anywhere in the world right now. So between all of this good news and bad news, I want to make clear that there are actually markets, many markets where you can build, blindly. I mean, no one would do that. But because there's so little assets in regions, particularly in West Africa, with such dense clusters of business going on, it's just the opportunity is boundless. The investment climate is still risk averse, as we hear from the banks and so on, but opportunity is bound. So if there's entrepreneurs out there, I would suggest that you look very closely at aligning all of what you need as far as professional disciplines, and make a plan to go right and aggressively.
I'll just have two very short messages. One is to the financiers out there. Look at hotels, get some experience. Don't look at it as a 10-year term. It's far too short. The Mount Nelson's 110 years old. So look at hotels, extend the amount of years that you give it to repay the debt. Look at being more creative in how you're going to put those things together. And that's a massive mind shift. But if you want to play in this game and you want to give your shareholders some value going forward, it's something I think you should take back and speak to. For the entrepreneurs and the guys who want to own hotels, number one is look at the opportunity, and number two is look at the exit strategy. Yeah. Everybody says we're going to build this, nobody says how I'm going to get out of this. Yeah. I'm 50, I don't want to work till I'm 70. Yeah. So we need to, and don't think your kids are going to do it. Don't think that at all. What is your exit strategy? I want to build now, I want to sell in 15 years' time. Who am I going to sell to? What am I going to do? How am I going to do it? Because that influences everything going forward, how much money you spend, which operator you look at, where you're going to build it, etc., etc., etc. So the exit strategy is equally as important as when you start with that vision in your mind.
Thank you. Last word from anyone? Yeah.
Well, talking about exit strategies, being a landlord or a hotel owner, we talked about greenfields and brownfields, but how about going concerns? where at the moment we have hotels for sale within Pangolin Hospitality that are marketed at a price considerably below replacement value. If you have to build a new hotel, you spend twice or 3 times the amount of money than what certain hotels are available for right now. Would IDC look at those transactions?
Christine?
No. IDC, our mandate is to create additional capacity and to grow the market, so we wouldn't look at that. What we have done in 1 or 2 instances is where it was really a rundown hotel, which was not really operated. The owner or the operator bought the building with their own contribution. We funded the refurbishment, but the acquisitions is really the space of NEF, but they fund acquisitions for lack of PE owner.
But Christine, maybe just there is one exception to that recently where the IDC is trying to support black industrialists. So, but there needs to be of a certain ticket size, so it has to be about 75 million. But essentially, if the buyer is a black industrialist and it's about 75 million, those would be very specific into the very good consumer competition.
Don't use me to be a black industrialist, so there's no fronting that is going to take place, yeah? Because then nothing will happen.
Yeah, the IDC is very sure about that.
Yeah. Okay, ladies and gentlemen, I think we can all compare an able, capable panel. Well done, and thank you very much.